not met before, I am really, really excited to be introduced to you. Claudia has done a lot of promotion and talking about this session on her socials and with her clients as well. And so, if we've not met before, hi, my name is Rachel. I'm a disruptor in the accounting industry. And so, I'm disrupting what it means to be an accountant, what it feels like to have an accountant, and disrupting the concept that you can't scale a business without losing yourself along the way. So, well-being and financial well-being is something that I talk about and promote about. If you cut me open, that's what comes out. I was a free school meal child and a charity shop kid, and having access to financial education through accidentally training to become an accountant changed my whole life. And so I am on a mission to just get this information to everybody who needs it. And sometimes the people who need it don't know that they need it too. And so I do that through contributing to features like Forbes, appearing on shows like This Morning and BBC News, talking about complex financial topics in ways that people can relate to and understand. And I also do that through Strivex, the accounting firm, which I co-founded with my husband, James. And so lots and lots of the people that are here today are our clients. We've currently got 770 incredible clients who are all aligned by a desire to feel better about their finances. And so I'm just really, really excited to have you all here today. And I am going to pass you over to the lovely Claudia.
Thank you so much, Rachel. Hopefully everyone can hear me. I'm really excited to be here today. So I am a regulated financial advisor. So I currently run my business under Quilter Financial Advisors. For anyone that hasn't heard of Quilter, it's a FTSE 250 listed company. I will put my details in the chat at the end in case anyone has any questions after today. But today I'm going to be sharing a webinar on financial wellbeing tips for sole traders, so any entrepreneurs, business owners, and the self-employed. Will cover we'll cover topics on protection. So as Rachel mentioned, products such as life insurance and some other things that as business owners and sort of sole traders you need to be aware of. We'll also talk about the importance of retirement planning. We'll cover pensions, and then we'll finish on some tax and wealth planning tips, as well as touch on mortgages. So hopefully there'll be something within all of that that you'll be able to relate to, and that will be interesting to you. I will start sharing my screen. Hopefully this works for you. So let me know if you can see that. Are we all good?
So I can see the screen and I can see the box that says audience window. So if you click enter full screen, it will.
Okay.
Yeah, all good.
Yeah, perfect. Thanks, Rachel. Perfect. So as I mentioned, financial wellbeing for self-employed business owners and entrepreneurs. Just a little bit of background on Quilter. So we provide comprehensive financial advice solutions for individuals and business owners, and that covers holistic financial planning. So it's really important for us to get to know our clients really, really well, understand you, understand where you are currently and where you want to get to, and help you put strategies in place in order to be able to do that, whether it's just starting out in your career or whether you're at the other end sort of thinking about your retirement. We're there sort of every step of the way, helping you plan your finances. So moving on to the agenda, as I mentioned, the first sort of part of the webinar is going to be about how to protect your income, your family and future as a business owner. So we'll talk about various ways of protecting the income that you earn on a monthly basis, what things you can be looking out for, and how to protect yourselves. Secondly, we'll then cover retirement planning. So for self-employed and business owners, it's something that might get missed. You're so busy running your businesses, you might not have time to kind of think about your financial planning and your retirement. So we're going to cover some topics there. And then lastly, just to finish, we'll touch on tax and wellbeing tips, as well as the mortgage process for self-employed. As Rachel mentioned, I'm also a regulated mortgage advisor, so that gives me the opportunity to also help my clients factor in how purchasing property will factor into their overall financial plan. So this chart just shows the stages essentially of financial life. So we work with clients. I've got some clients who are kind of in their early 20s, thinking about sort of starting out in their careers. So typically with those kind of clients, we will talk about perhaps their student loans, how we're going to look at structuring their repayments for that, saving for purchasing homes, potentially getting married, having children, as you move up, you might experience kind of promotions with your jobs. If you're running your own business, it might be just trying to scale that business, taking on members of staff. Then moving through to, if you've got children, starting to plan for things like school fees or inheritance planning. Looking a little bit later down the line, sort of between 60 and 70, it's looking at phased retirement and how we structure that for you kind of tax efficiently. And then there'll be other things we need to consider as you get older, moving into full retirement, potentially downsizing property wise, and then obviously looking into your long-term care plans and following on from that, the inheritance side of things. So it's a really broad range of advice areas, totally holistic. So we look at every single piece of your sort of life puzzle, as it were, and help you map out your financial future. I've just done a little slide here on running a business can be all-consuming, but don't neglect your personal finances. I'm also guilty of this. It's kind of when you're so focused on running your business, there are things that you let slip through, and sometimes it's just those things are really important, so we need to be focusing on that. First up, I'm going to talk about protecting yourself and your business. So as a self-employed business owner or sole trader, entrepreneur, whatever you might be, whatever structure you're in, you're reliant on your income. Essentially, you work so hard to run your business, and therefore it's so important that you protect yourself and your income in the event of being unable to work due to illness or injury, for example. I'm going to just talk about a couple of products that are out there. Obviously, just to caveat this isn't going to be individual financial advice. This is just giving you a little bit of knowledge to take away, to know what's out there. And then I would suggest doing a little bit of research on sort of your individual circumstances, or even speaking to a professional. But just to be aware of the types of products that are out there and the things that you might not be aware of. So the first one is income protection. So self-employed income protection insurance gives you peace of mind that you'll continue to receive a regular income even if you're ill and unable to work. If you think about people that are employed, for example, they might receive an income protection or sick paid benefits through their employer. Whereas if you're running your own business or you're self-employed, you haven't got those benefits to kind of fall back on and rely on. So having a look at what situation you're in currently, what would happen if you were ill or unable to work for a period of time? Have you got a sustainable emergency fund or a sustainable income that would continue to be paid regardless of your health condition, for example? If not, then having an income protection policy in place to protect you in that instance is a really good idea. The second one is critical illness. So obviously horrible to think about, but what happens if, as you're running your business, you get diagnosed with a serious illness, which we all might know someone that's been diagnosed with something serious, which has meant that they've had to take some time out of work. If you've got to take time out of running your business, that might mean that your mortgage payments are affected, or your savings plan that you've worked so hard to put together is affected because you're not receiving your income because you're unable to work. So having a critical illness policy in place that pays out a tax-free lump sum upon a serious diagnosis can help you pay towards your liabilities. For example, if you had a mortgage, it could help you pay off a lump sum towards your mortgage in order to reduce your payments. Again, this is something that a lot of employed people have as part of their work benefits package, depending on how generous their employer is. So it's something that they don't necessarily have to pay for. Obviously, we need to factor in premiums on a monthly basis, and both income protection and critical illness cover have a cost to them on a monthly basis, which will depend on things like your age, your health status, what your job role is, for example, and how comprehensive a cover we look at. But essentially, it's an insurance policy designed to protect you. So even though it will cost on a monthly basis, it is worth thinking about just to ensure that you're protected in any event. The second one is health insurance. So with health insurance, again, a lot of employed people might have this as part of a private group policy. They see it go out on their pay slip, so that their employer is covering them in the event of them needing some treatment, for example. So private health insurance for self-employed individuals essentially means that you have a separate policy in place to allow you to essentially seek treatment or private medical help, rather than being seen on the NHS, you can use the private health insurance, so you can avoid any lengthy GP waits, for example, or hospital waiting lists. So it gives you that peace of mind that if there were any health issues, you've got a separate policy that can cover you in that event. Lastly, we will move on to life cover for business owners and the self-employed. So life cover is if you have beneficiaries, for example, or dependents, people that rely on you as maybe the breadwinner, or someone that brings in money, outpays the mortgage, or you're relied upon. What happens if something happens to you? Essentially, you need to think about your children, for example, or your partner, or anyone that depends on you financially. How would they be left in a situation if something were to happen to you? So it's a good idea to think about that, what your liabilities are, whether you have a family home, if that's got a mortgage on it, what would you want to happen in the event of death. For life insurance, if you're a business owner, then there can be some tax benefits to purchasing a life cover policy called Relevant Life through the business. If you're not a business owner or you're self-employed, there are other policies that you can look at. But essentially, it's just protecting your dependents so that if something happened to you, they're left in the best possible situation at a pretty hard time. So I've just done a little breakdown here of what we've spoken about. So income protection, this typically pays out as a percentage of your salary or until you can return to work. The cover helps maintain financial stability, so it covers essential expenditure like bills and mortgages. So we'll need to go through what your job role is, essentially how much you're earning, and if you're self-employed, we will take figures from kind of SA 302s or tax year overviews. For critical illness cover, again, this insurance provides a lump sum. So this is a tax-free lump sum payment. So if you are diagnosed with a critical illness, such as cancer, heart attack, or stroke, this can cover medical expenses, modify your home for accessibility, or even help towards mortgage payments, like I mentioned earlier. And then life insurance essentially is for protecting your beneficiaries upon death, so it helps them manage the financial obligations like mortgages or bills, making sure that they are financially secure. We need to consider why you might want protection. So consider the financial risks to you, to your family, whether safeguarding against illness or injury is important to you, whether it's just yourself or whether you have someone else that is relying on you, will factor in essentially whether you feel as though you need this kind of protection. How much cover you might need will also depend on things like your liabilities, so any outstanding debts you've got, what your living expenses are like, your typical spending on a monthly basis, costs for education for any children or dependents, and other financial commitments. Can you afford the protection? So as I mentioned earlier, protection comes with a premium per month. So you need to consider what your monthly budget would allow for this kind of cover and what you could commit to the insurance on a monthly basis. And then lastly, can you be protected? So I mentioned that health insurance or income protection in critical illness would be underwritten based on sort of pre-existing medical conditions. So if you have had something in the past which might affect your ability to get cover, it's important to give the accurate information during the application process, just to make sure that you are covered from the beginning of the policy rather than having something come up at point of claim. So I put who might need protection and why. So essentially in early life, you might be a young professional just beginning your career. You might need protection against unforeseen events that could disrupt your career, or if you're in the early stages of starting your business, again, it could be just having some protection in place for that. Couples, as a married couple, you might be looking at purchasing a home together. So again, protecting those mortgage liabilities, protecting each other from the monthly payments to secure your financial future. Again, if you're a couple with children, you might be planning school fees, so you might want to protect against your children's well-being and financial future. And then lastly, into sort of the older years, we focus more on kind of retirement plans. So actually you might look to review your protection at that point and say, well, do I still need this protection in place? Have I still got those liabilities when I put the policy in place? Or actually, do I no longer need to pay for this on a monthly basis? I've got a essentials guide to protection cover. So if anyone here is interested in sort of having a little bit more detail on the types of covers that are available, what the underwriting process looks like, or just some more general information, please do request the brochure, and I'd be really happy to send that through to you. It's a bit more of a comprehensive guide than what we've had time to go through today. So let me know in the chat, or let me know at the end if you would like that. So moving on to retirement planning. So retirement planning is a really important part of what I do and what I speak to my clients about, whether they're business owners or whether they're employed. Everyone needs to have a plan in place for later life, to start thinking about when they might want to retire, and when they do, how are they going to be able to do that. So what we look at when we look at retirement planning is considering life expectancy. So on the Office of National Statistics, the average life expectancy, based on whether you're men or women, they have a calculator on there where you can see what your life expectancy is. So planning towards your later life is a really good idea. And to start, you just need to look at sort of what you've already got in place, how you can build on that, and essentially where you want to get to. So how we do that, and what I have a conversation about with my clients, is looking at the 3 basic income needs. So the first being core income. So thinking about money such as bills, groceries, things that you are committed to, that you need to pay on that monthly basis or yearly basis in order to live. Discretionary could be things like leisure, holidays, any things that you like doing outside of sort of the everyday. So making sure that you've got funds for things that you enjoy doing, hobbies, and then healthcare income needs. So again, if you've got plans for private insurance, you want to keep that going through your retirement, or unexpected future care needs, for example, we need to consider all of those elements into the plan. So typically the core needs will remain stable throughout, depending on what your living situation will be. Your discretionary income, will it start to rise? Will it start to fall as you get older? And then your healthcare income, typically as you get older, that need might become a bit more of a priority. So just making sure that we have the plans in place that address those core needs, the discretionary needs, and also those healthcare needs. So the essential steps to retirement planning, and this will differ for business owners than from what it might do to someone that's employed. So the first step is to establish your retirement goals. So if you haven't had a think about it, it's worth having a think about kind of at what age would you like to retire? Are you looking to retire at sort of your state pension age, for example, or would you perhaps like to aim for an earlier retirement? What does retirement look like to you? How much would you need in retirement? So work out kind of where you see yourself, where you see your business, what monthly costs you have associated at that point, and that we can work out from that how much you might need in retirement. Third step is to assess your income options. We'll talk a little bit about this later on as to how we can structure our income in retirement. And the fourth one is a consideration to tax implications. So although we're in retirement, we will still pay income tax based on any income that we derive from, say, pensions, for example. If that's an important part of your retirement planning, then you do need to consider how you'll be drawing down your income when it comes to retirement. So retirement means different things to different people. As we touched on, your retirement might look totally different to someone else's. Someone might want to go on lots of lavish holidays, and you might just want to have a fairly simple retirement. So you really just need to delve down into your goals, maybe speak with a partner or a friend to see what they've got lined up for their retirement, put together in place some financial objectives. Then we can work out, well, when should you start saving and planning for your retirement? Again, I've just covered here some questions that would be useful to maybe ask yourself if you haven't started thinking about your retirement planning. What is the minimum income that you might need to cover your outgoings? And that will kind of be your base level, like we talked about earlier, the core need. Secondly, would be how much would you like to be able to spend on non-essentials? So how many holidays would you like to go on? Do you like doing lots of sports or activities that require you to have additional income? Third would be state benefits. So are you entitled to state benefits? Have you been paying into national insurance so that you receive your state pension? How much state pension are you entitled to? And how much savings have you got, or can you save towards your retirement? That will also have an impact on your overall ability to retire and what the quality of life looks like at that point. Your income in retirement can come from different places. So you can look to use your pension allowance, which I'll come on to, how that forms part of your retirement. You might need emergency funds to provide for unexpected expenses. So as well as having your steady retirement income, you also want to make sure that you have a pot just at the side that you can use in the event of something unexpected arising. So pensions. Figure out what do you have, or what are you likely to have when you get to your desired retirement age. And that could be a state pension, that could be a workplace pension, that could be a private pension. Other sources include savings and investments. You might have a property or a second home that you rent out, and then what other financial support might be available to you. So figure out which of these you have, which of these you don't have, and start putting a plan in place to ensure that what your retirement looks like is achievable. So I'm going to move on to talking about pension planning for self-employed and business owners, which is actually extremely tax efficient. So if you're a sole trader, if you're a registered sole trader, your pension will come from your net profits. So the government actually add a 20% top up at basic rate tax. So for example, for every £100 you contribute to your pension, it really only costs you £80 with 20% tax relief given into the pension. If you're a higher rate taxpayer, you can actually claim more tax on your self-assessment form, but the pension will actually grow tax-free during its lifetime if you're invested. So it's a really efficient way of saving towards your retirement. And a lot of people, if they're self-employed, they might overlook this because in the past they may have been employed, so they've had a pension through their employer. But as a self-employed individual, you aren't automatically going to be enrolled into an employer's pension scheme. So taking the responsibility on yourself to set something up, even if it's just a small amount to start with, to get comfortable with saving money into your pension, because it is a longer term investment. Even just starting small, seeing where that's going to get you into retirement, and then looking at reviewing it on a yearly basis if your income goes up, for example, and you're able to commit a slightly higher amount to your pension on a monthly basis. I'll just talk through how pension contributions work from a limited company, as it's slightly different. Again, extremely tax efficient as a limited company, as you do save on corporation tax. So if you run your business as a limited company, your pension payments normally come from your turnover as a business expense. So you'll pay less corporation tax, but you won't get the same tax relief that will be added to your pension. So it works out essentially as a gross payment across. So really tax efficient if you are a limited company director. If you haven't got a pension set up, but you do want to start saving towards your retirement, I would definitely suggest having a think about what your retirement looks like and what you might be able to do to commit to that on a monthly basis. Moving on to state pension. So how much could you get? This is important if you're self-employed, just to double check that you are at the threshold for national insurance. So it's something to definitely speak to your accountant about. And if you have over 35 years of national insurance contributions, you'll be entitled to the full state pension. There is a form on the Gov website to check your state pension. So if you're nearing retirement, or you're just interested in what you could be entitled to at retirement age, you can request what's called a BR19 form to receive your entitlement in writing. So you can factor that into your retirement plans. If you know what you're going to be receiving from the state pension, then you know we can work backwards and figure out, well, how much more do I need and where am I going to get that from my other savings. This chart just shows the benefits of starting now. So these figures assume growth essentially. So to reach your goal, let's say the goal for investment was £100,000 in 30 years time, that would be £203 per month if you invested today. If you wait a year, you'd need to add £10 a month onto that. If you wait 5 years, you'd need to further add onto that. And then if you waited 10 years, you'd need to add an additional £136 more per month than if you started today. So it just shows the effect of growth and compound interest. If you're starting earlier, even if it is a small amount, you're definitely going to be in a better position than if you waited for 10 years to start those savings. You might have accrued benefits with former employers. So if you're self-employed at the moment, or you've just started your business, but you previously worked in a company, for example, you might actually have some pensions from your old employer, which can help you as a base level when you're into retirement. So I would always recommend figuring out where you worked, whether there's any letters or if you've received any statements from your previous pension provider, figuring out how much is there, what that's invested in, because that will form part of your overall retirement planning. So asking for an up-to-date statement from your previous pensions is a good idea to help you figure out what you're going to need to top that up. Again, we'll just touch on the different sources of income. So in retirement, you will still pay income tax on any income above your personal allowance. So you'll pay tax on your income received from pensions. So figuring out and calculating that into your calculations is going to be important. And it's something that I speak with about to my clients, is making sure that we structure their retirement finances as tax efficiently as possible, even into retirement. Okay, so just to summarize there, the retirement planning is starting off with establishing your retirement goals. So thinking about where you actually want to be in retirement. Do you want to be here? Do you want to be somewhere abroad, enjoying the sun? Do you want to be able to go on lots of holidays? Do you have lots of expensive hobbies that you need to plan for? So working out how much you then need for that. Assessing your income options. So what have you already built up to date? What could you potentially build up on a monthly basis to do towards those retirement planning goals? And then obviously considering those tax implications on the other side. So what your net income would be and whether that would be feasible for your retirement. So I've just created here 4 types of money. So things to think about. A useful tip is to create and maintain kind of 4 categories. Each category is managed slightly differently, as it's designed to serve different purposes. So the first one would be emergencies. So to cover core expenditure for the period of 3 to 6 months, this money should be ideally kept in a bank or building society so that you have immediate access. So this would be to cover things like if the boiler broke, or you need to replace your car, or you just simply have to take a little bit of time out of work. Having these savings to say 3 to 6 months to cover core expenditure is a good idea to have in liquid cash that's available to you to use. Then we move on to short term, which is typically 1 to 5 years. So for example, it might be saving for a house deposit or making a major purchase. You want ideally short term access to this, or a short term notice period that if you need the funds, you can get access to them. Medium term would be more like 6 to 10 years. So taking into account the effects that inflation might have on those funds over the longer term. What the longer term aims and goals are, is that might affect which kind of products you use towards the medium term goals. And then longer term, this would include things like retirement that we spoke about. So looking at your pension, how that's invested, whether it's inflation improved, and your longer term goals and aims for retirement. So thinking about those 4 different pots, whether you're just starting out, like I say, or you're sort of at the other end looking at when can you retire, how can you retire, it's important to consider all of these within that. I spoke about inflation and essentially the importance of keeping up with inflation and growing your money. So we spoke earlier about the effects that inflation have on your money, essentially giving you less buying power. So it's usually expressed as a percentage. It means that essentially the same amount of money, you'll actually be able to afford less in the future as a result of higher inflation. So just a little graph here to show you the effects of inflation over time. So the green line is showing a 2% inflation, so what that £10,000 would be worth. The grey line is 3%, and then the blue line is 5% at the bottom. So just showing you the effects that inflation has on £10,000 worth of cash over a 20-year period. So if you left your money, for example, within your pension, but it was just in cash, actually it wouldn't be worth £10,000. It could be worth, say, just under £4,000, depending on the rate of inflation over the next 20 years. So that's when I mentioned earlier about asking your previous pension providers for an up-to-date statement so that you can figure out actually what is that pension invested in. Is that invested in cash? Is it in stocks and shares? Is it in line with your risk profile? Is it in line with your wider objectives? So making sure that you're keeping track of what you've already built up, and then moving forwards, making sure that any plans you do put in place are going to be in line with your goals and your risk profile. Again, this graph here just shows the changes in landscapes. So investing over the longer term. If you would have just kept the funds in cash, essentially you can see the effects on the purple line at the bottom. Then we can see if you were to have invested in global bonds and then versus global equities. Again, I would always suggest getting personal advice on your situation, because you might have only a small time frame towards retirement, so it wouldn't be a good idea to take huge amounts of risks with your money if you feel that you will need access to it. Whereas if you are someone who's just starting out, you might feel as though you have a higher tolerance to risk because you have a longer time frame to retirement. And this chart here just shows, based on the previous graph, so the investment of 10,000 global equities would have grown by over 1,000% over an investment period of 30 years. So that £10,000 would be worth £110,000 if you had invested in global equities over the 30-year period. Again, just a caveat on this is it's based on personal risk profile. So it's a good idea to essentially review your existing investments, think about how your tolerance to risk is, maybe speak to a professional to get their opinion on it, and making sure that every investment you put in place is in line with your goals and objectives. I'll just touch on other planning. So as you would have all heard in the recent budget, there were some changes to taxes that we need to be aware of. I'll cover a couple of things with regards to ISA allowances and capital gains tax shortly, but it might be that alongside your pension, you also want to think about other financial products that could help you into a future, whether that be a junior pension or a junior ISA for your children if you want to plan to save for them in the future, or it could be a general investment account to make sure that you're using your tax allowances. Personal pension there, which we've touched on, and then there are other various products available, so it's not just pensions that you should use towards your longer term retirement. You have a £20,000 ISA allowance each that you can use to earn interest or investment growth free of tax. So that's £20,000 per tax year that you can invest into an ISA, which is an individual savings account, meaning that you can start to invest. Any returns on that growth would be free of capital gains and income tax. Everybody also still has the capital gains tax exemption, which is £3,000 per year CGT. So it means this is an allowance you can earn tax-free from investment returns, and if you don't use the allowance, you do lose it. So make sure that you review any current investments you have to ensure that they are tax efficient. Lastly, mortgages. Now, this is a really interesting one for the self-employed. So the exact definition varies by mortgage lender. So each lender has their own criteria when it comes to mortgages. In simple terms, generally you will be considered self-employed if you own at least 20 to 25% of a business. So consider that within your current structure. So are you classed as self-employed, or would you be classed as employed by various lenders? Looking at how much we can borrow, there is unfortunately no one-size-fits-all answer to this question. I speak with a lot of lenders sort of day to day when we're trying to structure a mortgage application for someone, and they might use a multiple of income based on SA 302s and tax year overviews if you're self-employed. Typically, if you're employed, they just require 3 months pay slips. So it's a little bit sometimes easier to evidence that the salary on a monthly basis. But if you are self-employed, they will ask for generally the last 2 years of self-employed income. If you have only got 1 year, it is still possible to get a mortgage, but the lender pool might be slightly more restricted. It's just a case of knowing which lenders to go to, what their requirements are, and how you need to evidence that. You essentially just need to show the lender that you can afford to make the repayments. So they'll look at things like credit commitments. Do you have a student loan? Do you currently have any credit cards or hire purchase, any car loans that you need to repay or that need to be factored into the monthly affordability? It does really depend on your circumstances though. So for self-employed, it does depend on what your outgoings are, what your business is like, how you've structured your income. Things to consider. So if you are looking in the next few years perhaps of purchasing property, you might want to speak with your accountant about maximising profits in order to help you secure higher lending. So as I mentioned earlier, lenders typically will look at your income over the last few years. So if you can evidence a higher profit from your company, then you're essentially showing them that you're able to afford to borrow slightly more. Another tip is to avoid taking out sort of large loans or credit ahead of any mortgage applications. I would always try and avoid doing that if you know you are going to be looking to purchase a property. Ideally, wait for any big purchases until the offer has been approved or you've completed on your property. Have a think about essentially whether you could afford the repayments if interest rates increased. So as we've seen over the last couple of years, interest rates have really gone up. It's affecting a lot of people's monthly repayments. Some people might have to downsize or sell. So just asking yourself, well, if this interest rate increase, would I still be able to afford that mortgage? And then lastly, understand how certain lenders treat self-employed income. So just knowing if your bank says they don't lend to self-employed, for example, or they aren't able to use your SA 302s or tax year overview because you've only got 1 year's trading, that's not a problem because there are lenders that would be willing to consider it. So just make sure that you're taking the advice on that and looking at the wider market for those mortgage needs. I've just put a little thank you slide. So again, just to reiterate that if you have any questions or you want to talk about your sort of personal financial circumstances, I'm more than happy to do that. And this is sort of just a general guide. I know Rachel's going to circulate hopefully the slides around so that you can refer back to them if you need to. But thank you, and I'll open up for some questions.
Alrighty, thank you so much. We've had some really good questions. I'm actually just going to pop the chat out so that I can see it. Lots of juicy questions. Okay, so we have got, will life cover policies that we put in place when we were employees not cover us now that we're self-employed? And do we need a different type of policy now?
Yeah, so it's a good idea to check with the provider that if you're no longer employed by the company, it's likely that you're no longer employed under the group policy, unless it was a private policy that you took out whilst you're employed. So I would always recommend asking the provider for a statement of your insurance policy. But like I say, if it's an employee policy that you were part of previously and you're no longer employed by that policy, there might be a stipulation in there that if you left the company, you're no longer part of the group protection policy. So I would always suggest reviewing those policies to make sure.
This is a common question that we get. Can health insurance be put through the business, in brackets, limited director with no employees?
That's one for you, yeah. It's one that we get all the time as well. It's the relevant life cover that you're able to claim as an expense, but because there's essentially a private benefit to it, it wouldn't be able to be put through the business.
Yeah, so relevant life cover specifically is the one insurance policy that we can claim through a limited company wholly and exclusively. When you start to grow and you start to get employees, it does change again in terms of if you are offering something to everybody, you can also offer it to yourself. However, you do still need to put through something, either a P11D or put it through on payroll as a benefit in kind. So if I take us as an example, our team all get access to an employee assistance program. We have a very high level healthcare program. So we will have private medical and AXA health insurance that is available to our entire team. Again, it can't be based on things like performance. It has to be offered to everybody, not just you as the director. And anybody who gets that also has to put it through either through payroll once a month or as an annual P11D. That's something that we can do for you. So it's nothing that you need to worry about. But if you are considering putting that through for your whole team, I would definitely encourage you to reach out to us. We can have a chat about it, even if it's just like how we do it as employers. So our team get access to their full benefits package that includes health insurance, and we also pay for their gym memberships. And so all of that goes through as a P11D benefit in kind at the end of the year. If you've never heard the word benefit in kind before, benefit in kind is just an umbrella term for any benefit that you or your employees receive as a result of being employed by that person. And so our annual workcation, as an example, is a benefit that they receive. Their health insurance is a benefit they receive, and their gym memberships is a benefit that they receive. We pay for all of it for them, but they do have to pay tax on the amount of the benefit they receive. So if someone was in the basic rate band and we put through their healthcare, they would pay 20% tax on the healthcare, but we pay for all of it for them. So if you're thinking about offering any of that to your team, just let us know. We can help you. We can just sort of walk and talk you through how we do those things and how we can put things in place that make sure that if you were ever investigated by HMRC, we've got something on file that showcases why you're allowed to claim that and why we've enabled you to do that too. Um, Holly asked the same question. So she said, can critical illness and income protection be put through the limited company? And that one is a no. So is relevant life cover, I'm right, aren't I, Claudia?
Pardon? The relevant life cover
is the one that can go through the limited company.
Yeah, relevant life cover is essentially like a life cover for the director of the limited company that can go through the limited company. Otherwise, like Rachel said, if it's essentially got a benefit to you as a personal benefit, it would be treated as a benefit in kind, so you'll essentially pay tax on the benefit if it's critical illness or health insurance. The only exception to that is relevant life.
Awesome. Alrighty, sorry, I'm just trying to make sure I'm answering everybody's questions. Is income protection or critical illness allowable as self-employed? No, that's also a no.
Questions on that?
Can you pay into your private pension from your limited company? The answer is yes. So when Claudia was talking about making pension contributions that are tax efficient, one of the best bits about being a limited company director is by being able to utilize a lot of the profit extraction and future planning opportunities. So each year in the UK, there's something called the private pension allowance. At the UK at the moment, that's £60,000. And so if you are a limited company director and you have the champagne problem where you've got too much profit in your limited company, you've extracted what you need in your personal life, and you're considering how else you can extract the profit from your limited company in a tax efficient way, we can actually extract up to £60,000 of profit for tax from your limited company to a private personal pension. That is corporation tax deductible from your limited company. So pound for pound, anything that you invest into your private pension, that reduces your taxable profits. And so that's also reducing your corporation tax. So we can extract £60,000 up to, it doesn't have to be around 60. If you've got 10K spare, you can do 10K. £60,000 every single year from your limited company into a private pension. And again, that's completely tax deductible. And so if you had extracted everything that you wanted to for the year, you had £50,000 left and you didn't want to pay corporation tax on that 50,000, if you put that straight into a pension, we can deduct that from your taxable profit and therefore reduce your corporation tax bill to nil as a result of doing that too. Again, it's really important to note that for a lot of people, it's important to make sure that you are making really proactive long-term decision making rather than just being like, how can I get the corporation tax low as possible? And so I'd always recommend speaking to somebody like Claudia before you put these plans in place, because it could be that if your short-term plans are to get a mortgage, actually that wouldn't be a great thing to do because you're reducing your profit and therefore reducing your borrowing ability. And so as with all things, there are pros and cons of all of them. The pro here is that you're extracting that money tax-free from your limited company straight into a pension. The downside of that is it is reducing your profit and therefore reducing your affordability in other areas. Oh, good question from Jen. As a limited company owner, I don't pay national insurance. How does this work with the state pension? I'll jump in on this in case Claudia wants to add anything afterwards. So as a limited company owner, you won't pay national insurance if you are paying yourself a low director's only salary. For the 25-26 tax year, you probably actually will start paying national insurance. But in the tax year that we're in, if we process a tax efficient salary for you, depending on the amount that you pay, one of two things will be happening. Either you will be processing each year as accountants, it's our job to play limbo and work out how can we get a salary that is low enough that you and the company aren't paying extra tax and national insurance, but that you are claiming as much of your tax-free personal allowance as possible, whilst also making sure that you get a stamp for national insurance. And so it could be that you're not actively making national insurance contributions, but you are earning at the national insurance threshold. So there's an important difference there between the two. You can gain national insurance stamps by earning up to the threshold without making national insurance contributions. The second thing to say is if you're not making national insurance contributions as the owner of a limited company within the company, it could actually be that your accountant is helping you to make national insurance contributions through your self-assessment. And so the best thing to do is, and this is as the owner of a limited company, you'll feel like you've got 17 government gateway logins. However, you can set up, separate to your self-assessment login, you can set up a personal tax gateway. The personal tax gateway is not your self-assessment login details, it's not your limited company login details, it's your personal tax login details. This will go back as far as you have been making national insurance contributions. So mine goes literally back as far back as the day I turned 16 when I started my first job. I can literally see a report under my own name that tells me every single tax year that I've been working, if I met the requirement, if I made contributions, and it can also show you where there's any gaps. If there are gaps, you can literally just pay a nominal fee to make sure you cover those gaps so that you can withdraw a full state pension when you want to. Again, if you have an accountant or if we're your accountant, just chat to us about this. If we are your accountant, we will normally make sure that you are hitting all of the national contributions on, because we try and think about these things so that you don't have to. So if you're a client of ours, we will have thought about this. But if you are unsure, or if actually you're like, I think I'd sleep a bit better tonight knowing where I'm at, and if you have gone back and maybe filed self-assessments yourself, it could be that you're like, did I do that right? I'm just going to go back and check. And so in your personal tax government gateway, you can literally go back, look at all of the tax years, and just check how many contributions you've made and if you've qualified. So that's really important for things like maternity pay, paternity pay, and also retiring. But it's super easy to set up and create a personal tax government gateway. You just need a recent payslip, a recent P45, or a recent self-assessment, and we can provide you with the information if you don't have it. So you can set it up in a couple of clicks and log in and see all of the previous tax years and whether or not you made contributions. Again, if there have been any years where you've missed any contributions, you can go back and pay a nominal fee and retrospectively cover those tax years so that you can claim a state pension. Claudia, anything else to add?
I think you've covered it. Yeah, I was just going to say on that, you can add years if you have realised that you're missing some years. You can go back and make those contributions. So it's worth doing. Again, you can look at your BR19 form on the Gov UK website to check your estimated state pension. If you feel that it's wrong based on your national insurance record, always just query it with someone like myself or Rachel, and we can help you.
Awesome. We've got a very specific question from Ophelia, but I think this will be helpful, especially considering the state of the UK at the moment. As someone who doesn't plan to stay in the UK for her whole life, would a pension still be a good investment? Does anything change in terms of that pension access if I no longer live in the UK?
Oh, that's really difficult. Cure pensions, which is where a transfer out of the UK, is not my area of expertise at all. However, there are specific rules about transferring pensions from overseas. So I can put you in touch with actually one of my colleagues who deals with those pensions. If you are thinking about that, how it would affect you. Essentially, whilst you're a UK resident and UK tax resident, you will still receive the same tax benefits. But it's important to, I think about your longer term plan. If you are thinking, well, actually, I'm going to be moving abroad or moving somewhere else where the tax system is different to the UK, you need to see what the tax agreement is cross-border between those two places, as that could have a wider impact on your overall retirement. So you might not want to plan on saving all your retirement here if actually you're going to be moving abroad and it will be treated differently. But yeah, I would suggest getting some sort of proper tax advice depending on where you are looking at relocating to. As there could be tax advantages to it as well. If you were to save here and then move abroad, there could also be, on the flip side, there could be benefits to doing so. Sorry, that doesn't really answer it, but hopefully.
Another juicy question. So this one's from Holly. Hi, Holly. As a limited company director, hoping to buy a house in the next 1 to 2 years, would you recommend leaving as much profit in the business by reducing your dividend payments, or do lenders look at pre-dividend profit as evidence?
Both, to be honest. It depends on the lender. So again, this week I've been doing quite a few self-employed applications where exactly that, the profit's been extracted as dividends. So we've evidenced income through dividends rather than through sort of company profits. So different lenders will look at it differently. So you're not going to restrict yourself by doing one or the other, as they will look at sort of the entire case. I saw someone asking a similar question actually, but now I can't see it, so it probably might cover that. It might cover that as well.
Cool. I'd say as well, like Holly, I know that you're a client of ours. Whenever we request information at the end of the year, so let's say your company year end is the 31st of October, we'll be in your inbox in the first week of November requesting the information for that period. At that point, one of the most important questions that we'll ask you, because we'll be asking you very boring questions like, can we have your bank statements? Can you let us know if you sold any assets? One of the most important questions that we ask you is, what is your priority for this set of accounts? With the context of most people, most of the time, want to prioritize tax efficiency and keep things as tax efficient as possible. However, in some instances, basically when you're trying to get a mortgage, we park tax efficiency and we try and prioritize profit extraction and making you look as profitable as possible to make sure that you're able to get that as well. And so it's really important to, the reason we ask that question is we can prepare your accounts with that in mind and start the conversation either in the financial year when we get in touch with you at month 9. So we get in touch with you at month 9 and invite you to a month 9 MOT. And that's where we'd say to you, like, you've got 3 months between now and the end of the year. If you're looking to get a mortgage in the next few years, here's what you can do in the financial year to make sure that when we start preparing your accounts, we're doing it with a mortgage in mind. Which is, sorry, I just saw your follow-up message saying thank you. Oh, this is an interesting question. Nicole has asked, how much percentage of ownership of a limited company do you need to own to be classed as self-employed for mortgage purposes? I missed the start of what you said. Am I right in thinking that's 1%?
No, so for mortgage purposes, they will usually treat you as self-employed if it's between 20 to 25% of ownership of the company. So if it's less than that, generally you might be treated as employed. I had one recently where the client was just on the border. So yeah, some lenders will be 20%, some might be 25%, but the majority, yeah, if you own sort of at least 20% of a company, you will be treated as self-employed by most lenders. Again, there are some exceptions to that, but yeah, mostly 20 to 25%.
This is a very common question from Catherine, which says, for a mortgage, will it be a disadvantage to only have 1 year as a limited company, even if I have 4 years prior to that as a sole trader?
So if your sole trader work is the same in the same field and the same line as what you're now doing in your limited company, then it's likely that it won't affect it. If you, let's say, had 4 years as a sole trader doing something totally different and then launched a new limited company, you're probably going to limit yourself to a pool of lenders who will only consider 1 year of limited company accounts. But as long as you can evidence sort of moving, which is quite common from a sole trader to a limited company, the lender will take that into consideration. So it shouldn't put you at a disadvantage as long as it's in the same or similar industries.
I'd say as well, like, I feel like just as a self-employed person, not as an accountant, as a self-employed person, I was definitely raised, and I think it's like our era of self-employed people, I was definitely raised with a lot of like fear around lending and being able to get a mortgage as a self-employed person. And actually, my experience has been very the opposite in terms of, if you've got a great accountant that can really help to work with you in the financial year to set your priority in your business and your accounts up for success. So we have our limited companies, but we also have a portfolio of rental properties, and year on year on year have literally never had any problems lending. And I think it's something that can feel quite hard to talk about, but actually it's really important too, because my biggest blocker of ever going self-employed was like lending options and being able to go self-employed and get mortgages. And so I think one of the key takeaway from this is planning is the most important thing you'll ever be able to do. And with good planning, most things when it comes to lending, as long as it's reasonable, are very possible with great planning, proactivity, and a strong financial investment in your finance function as well. Okay, Daniel's asked a specific one. For long-term planning, should a limited company director try to factor in the business asset disposal relief, or is it always better to try and extract profit and do something like pensions/investing?
So for long-term planning, if you're planning on, so the business asset disposal relief is if you're selling a business, so that's also recently changed. I think it will depend on your personal goals, number one, in that if you're looking at being tax efficient and reducing sort of corporation tax, and you want to be really tax efficient from your company, and you haven't used things like pension contributions, it is worth doing. But also to caveat, that depends on your age. So whether you're anywhere near retirement, are you then going to be locking up those funds for a really long time that you don't want to? So it is gonna depend on your overall goals, I would say. But obviously, extracting profit from your limited company through things like pensions is tax efficient. If you haven't used those allowances, I would suggest sort of looking at those if you're looking at getting money from your company into your own personal name tax efficiently.
Yeah. Just to jump in from the shiny accountant side as well, my role within Strivex is lots of like high level consulting. And I work with businesses before, during, and after going on shows like Dragon's Den and Shark Tank, and also people who are planning to exit their business, do angel investment or venture capital funding. And so it's important here to note that there's quite a big difference between disposing of your business, in which you'd qualify for business asset disposal relief. It, they couldn't have thought of a nicer name than business asset relief. But it's basically capital gains tax when you sell your business. And so it's important to note here when we're looking at selling businesses, whilst some of the value is dictated by how much profit is in the company, not all of it is. And that actually, with ongoing traction and a really good business model, that will have far more influence over the value that you can sell your business for than actually how much retained profit is in there. And most of that belongs to you anyway. And so I'd say if you're planning to exit your business one day, don't let that impact your short-term profit extraction. Most of the business valuation, you would want to extract all of the profit before you sell anyway. You would be selling that profit anyway. And a lot of the valuation comes from other things like traction, plans for the business, the ability for that business to run without you. And so if you are planning on exiting your business, doing angel investment or venture capital funding, just shout. Those valuations are something that is literally my full-time job. And so even if you just want a bit of a whistle-stop tour of like how we value a business, it can probably help you to understand why those two things are quite separate conversations anyway. But business asset disposal relief, you might have otherwise heard it called entrepreneur's relief. It is basically the capital gains tax of exiting your business. And I think a nice question to end on, which was the last question, I'm just trying to scroll up to find it, was I'm just now having the headspace to really understand all of this. Do you have any good book recommendations or a podcast that talks you through investing and retirement planning in a helpful and simple way?
Yeah, and I actually saw that question, and I saw someone's response, and I was totally agreeing with Meaningful Money. So it's a podcast by Pete Matthew. So that's on or wherever you get your podcasts. But I also have a list of podcasts and blogs that I've recently been reading, so I'll be happy to share that as well. I mean, books are tricky because obviously, as we've seen over the last couple of weeks, the rules change all the time. So I'd suggest reading podcasts or blogs, things that are up to date, so that you're not going off of older information. But yeah, I would second Meaningful Money.
One final question from Jeff. Jeff said, I lived abroad for a long time and have quite a few national insurance gaps. Is there any way I can start paying those off directly through my limited company, or do I have to do it out of my salary/savings? So you do have to pay those personally. That is a personal tax. Making those payments, if you want to do more research on it, it's called voluntary national insurance. And so that's where you voluntarily top up and cover those gaps in national insurance. The downside to doing it retrospectively is that you pay national insurance at the current rate. So if it's class 2, it's £3.45. And if it's class 3, it's £17.45 for a week. But again, Jeff, I'd recommend if you go back, if you create a personal tax login, look at what the gaps are, and you can bring that to us. That's something that we can help you do through your self-assessment process as well. Or it could be that you decide to do it a bit more gradually. So you can almost put a plan together to make sure that you're paying off 2 years every year between now and when you retire, to just make that cash flow a little bit nicer as well. But just, I would recommend logging into your personal tax, assessing the situation, and then if you need any help from us, you can also put time in with us for free at any time. Perfect. Lots of nodding from Jeff. Alrighty, cool. So that's all of the questions. I'm now just going to stop recording.